be starting off with stocks, Alibaba, and then Athena will be talking about mutual funds, and James will be talking about bonds. Alibaba is a Chinese e-commerce company that provides consumer to consumer, business to business, and business to consumers sales services. It also provides electrical payment services and shopping search engines and computer services. The group began in 1999 when Jack Ma founded the website Alibaba.com, a business to business to connect all Chinese manufacturers overseas.
Hi, my name is Athena and I'll be explaining the mutual funds. So, as of 2015, the U.S. News calculated 17 long-term bond funds. Their list highlights top-rated funds for long-term investors based on the ratings of leading fund industry researchers. So, the risk associated with this mutual fund is that the alpha for 1 year is 3.12. For 3 years, it's 2.19. For 5 years, 2.38. And the beta for 1 year is 0.7. For 3 years, 1.11. For 5 years, 1.02. The mean annual return for 1 year is 0.38. For 3 years, 0.34. For 5 years, it's 0.46. The R squared for 1 year is 77.45. For 3 years, it's 49.56. For 5 years, it's 36.80. The standard deviation for 1 year is 2.34. For 3 years, 4.59. And for 5 years, it's 4.68. The Sharpe ratio for 1 year is 1.92. For 3 years, it's 0.87. And for 5 years, it's 1.16. And the best 3-month return has been 20.30%, and the worst 3-month return has been negative 17.16%. The fund that was ranked in the first place is the SEI Tax Exempt Trust Tax Advantage Income Fund, and the symbol for this fund is SEATX. So this investment seeks to provide the highest level of income possible in a tax-efficient manner. The fund normally invests at least 50% of its net asset in municipal securities, such as bonds that pay interest that is exempt from federal income tax, including the alternative minimum tax. The SEATX fund has returned 4.13% over the past year, 4.09% over the past 3 years, and 5.31% over the past 5 years. And fees are above average compared to funds in the same category, as SEATX fund has an expense ratio of 0.86%. As of November 11th, 4 p.m., the closing price is at $10.12. And the rate is 0.10%.
Hello, my name is James and I'm going to be talking about bonds. Bonds are a form of debt. Bonds are loans or IOUs, where you serve as the bank. You loan your money to a company, a city, the government, and they promise to pay you back in full with regular interest payments. A city may sell bonds to raise money to build a bridge, while the federal government issues bonds to finance its spiraling debts. First, there is the risk that proceeds from a bond will be reinvested at a lower rate than the bond originally provided. For example, imagine that an investor bought a $1,000 bond that had an annual coupon of 12%. Each year, the investor receives $120, which is 12% of $1,000, which can be reinvested back into another bond. But imagine that over time, the market rate falls to 1%. Suddenly, that $120 received from the bond can only be reinvested at 1% instead of the 12% of the original bond. Another risk is call risk, the risk that a bond will be called by its issuer. Callable bonds have call provisions which allow the bond issuer to purchase the bond back from the bondholders and retire the issue. This is usually done when interest rates have fallen substantially since the issue date. Call provisions allow the issuer to retire the old, high-rate bonds and sell low-rate bonds in a bid to lower debt costs. Default risk. The risk that the bond's issuer will be unable to pay the contractual interest or principal on the bond in a timely manner or at all. Credit rating services such as Moody's, Standard & Poor's, and Fitch give credit ratings to bond issues, which help give investors an idea of how likely it is that a payment default will occur. For example, most federal governments have very high credit ratings, such as AAA. They can raise taxes or print money to pay debts. They can default highly unlikely. However, small, emerging companies have some of the worst credit, BB and lower. They are much more likely to default on their bond payments, in which case bondholders will likely lose all or most of their investment. Inflation risk. The risk that the rate of price increases in the economy deteriorates the returns associated with the bond. This has the greatest effect on fixed bonds, which have a set interest rate from inception. For example, if an investor purchases a 5% fixed bond and then inflation rises to 10% a year, the bondholder will lose money on the investment because the purchasing power of the proceeds has been greatly diminished. The interest rates of floating rate bonds, which are also called floaters, are adjusted periodically to match inflation rates, limiting investors' exposures to inflation risk. The bond that I would recommend purchasing is the Colorado Bond Shares A Tax-Exempt Fund. The current price as of November 12, 2015 is $9.11, which is fair considering the 52-week low and 52-week high. The company's total net assets are upwards of $927 million, meaning the company has a lot of stuff, which makes it a fairly secure investment. With this calculator here, we can use the starting year and basically predict what kind of growth you could expect. We'll set this to 2014. And say we're going to do an initial amount of $5,000. So based on that $5,000 investment, you could be making $488 in just 1 year. That is a fairly good return, and it's a safe bond that you should invest in.